Good afternoon, folks. Before I start, I wanted to just tell you the background of this slide is actually the NFT. You can get it at our booth just by playing a little game of the ZK order book. Then you will get this NFT. And the booth is at the entrance building. That you can go check it out. For those who don't know me, my name is Jerry. I'm the co-founder and the CEO of Term Structure. I've been working in investment bank for 25 years, starting from money market traders, and then fixed income traders, and then foreign exchange trader. During the last 12 years, I was managing the Greater China trading desk. Main responsibility will be, of course, risk management, business development, and of course, governance. So I decided to retire last year because of this, the evolution of DeFi. I have spent some time looking at DeFi, and I figured out that what I have been doing in TradFi for 25 years is not seen in DeFi. So I make my decision and decided to retire and jump into DeFi. So here I am. Let's start to look at what we can learn from traditional finance. Right. If we look at the debt financial market, there are three pillars supporting this market. So the first one is the money market, and then foreign exchange and fixed income. So what does money market do? So money market lets the market participant to borrow and lend the short-term liquidity or cash management. So it normally is a floating interest rate. And in DeFi, we have Aave compound MakerDAO. They serve a similar function. And then we have a foreign exchange market. That actually is a marketplace for people to exchange different currencies for payment, for investment, or for hedging purpose. And here in DeFi, we have a Uniswap, we have Curve, we have a balancer, some similar purpose. And in financial market, we have a huge fixed income market, which is even bigger than equity market. But in DeFi, we don't see any fixed income protocol that being successful, just like what we've seen in money markets and the exchange market. By the way, I wanted to check here, how many of you, if you can raise your hand and know what does term structure means in financial markets? Okay, I think less than 10 and less than 10%. So term structure means the relationship between year to maturity and the time to maturity. If you draw the picture of the relationship on the chart, you will see the curve. That curve we call yield curve. So this is a definition of a term structure of an interest rate. That's why we decided to use term structure as the main thing that we want to do. So let's take a look at the potential market size here. So fixed income market in our real life, it's over 100 trillion US dollar. With this as an underlying, we have interest rate derivatives market, which is 6 times bigger, right? Over 600 trillion. But you may think, why do we need that huge interest rate derivatives? Because people need that to hedge your asset and liability on your balance sheet. But we don't have that luxury in DeFi. And then people use the interest rate derivatives to reduce your funding cost. Use interest rate derivatives to enhance your investment return. That's why we need the interest rate derivatives. But if you look at the DeFi, the top 10 DeFi, we only have a TV of 12 billion. Even the whole DeFi probably is still at 12 billion. But that is actually coming from this white dot. So if you think of maybe 400, 500 years ago, the TradFi fixed income market is just the size of the white dot. And think of what we want to do here. We want to expand that white dot to how much? Like a 100s, 110s? You think about that, how big we want to extend that white dot, then how much jobs that we need to do today. So let's look at the trajectory of the market evolution. So this is the product complexity. We are here at the money market stage. The white dot comes here. But we don't have a bond market. So interest rate, forward, term futures, options, all up to the structured products. Basically, the market is really, really capped. So what we need to do is to first build a bond market on top of the money market by using the theory of discount factor. With discount factors, we will be able to find the bond market through the proper mechanism or marketplace or system, protocol, whatever we can build. And with the fixed interest rates being found, then together with the money market floating rates, no matter it's the overnight rate or the interest rate by block, we will be able to construct interest rate swaps. With the interest rate swaps building up together with bond markets, then we can leverage the theory of interest rate parity to figure out what is the forward price. The forward price means that if today you want to exchange the ETH into USDC 1 year later, what is the price that you can trade with? What is the price that you want to deal with your counterparty? This forward price is for you to hedge the future exposure. Or you want to design any structured product, you always need a forward price. And then once we have a forward price, we will be able to build up term futures. Perpetual future is a great invention. It gave us the opportunity to trade and to express our view on cryptos, to give us the opportunity to arbitrage or speculation, right? Or you want to trade based on the funding fee, right? You can do a lot of things, but you cannot hedge 3 months, 6 months, or 1 year with certainty of your funding fee. So term futures serve that purpose for you to be able to hedge without like cash. You just use margin to hedge through the term futures market. That's what we do in TradFi. And then with those market build up, then we can leverage the Black-Scholes models or other option pricing methodologies. You will be able to find the options. You may argue that we already have an options market, but if you ask any option traders or any option service provider, platform, exchange, they will tell you it's just too small. There is no scale. They don't have a hedging tool because there is no forward. The option traders, they need to hedge forward, particularly if we do 1 year options, they need to hedge 1 year forward. Otherwise, they are exposed to interest rate exposure for 1 year. Then we can think of further structured products or real-world assets we want to package by using options, futures, forward, interest rate swap, or bonds. So we need to go step by step to build this, to make it a scalable market. What about the market structure? What makes a full fixed income market? Of course, first we need a fixed rate, fixed to maturity date. So with that, the next thing that we need to build is a market-driven marketplace. What is market-driven marketplace? So currently, the people in crypto like to use automatic market maker, but that only gives you a choice of take it or leave it. You cannot leave an order to buy or sell a bond tokens or to borrow or lend a your preferred price. So we need to build a protocol which allowed our users to decide what is the level they want to trade. They can leave an order for a couple of hours, couple of days, until it traded or they just cancel the order. So we need to build that. And then after that, we need, what does the fixed income market compose of? It composes of three interdependent markets. They are primary market, secondary market, and the repurchase market. We call it repo market. So primary market is the marketplace for borrowers to borrow fixed interest rates at the fixed to maturity date. So with that, then we will know what is the funding cost or potential return for the fixed interest rate at a certain period. And here in DeFi, when we talk about primary markets as a lending, of course that we need like one of the token to be the over-characterized token, and then the other tokens or the same tokens can be the borrowing underlying token. So this is what we want to build. And then the next is the secondary market. The secondary market is a marketplace for you to discover the price for an investment tool for the certain period of time. So people can live in order than buy and sell bonds. So they are the price discovery mechanism for people to decide where they want to invest with the minimum risk, without credit risk or like minimum platform risk. And then third one is the repurchase market, which is repo market we're talking about. And the repo market actually is a market for the bond holders or bond token holders to use that bond token as an underlying as a collateral to borrow the tokens for a short period of time. This is the marketplace for people to leverage, or if you need it for some certain cash management for only just a few days, or you need to adjust your liquidity position, you use repo market. With all this in place, the one more thing which is very important that we need is the primary dealers. So we need to have a primary dealership system where provide incentive for primary dealers to provide the market liquidity, to be the market maker for primary markets, secondary markets, and the repo markets with incentive. Of course, the primary dealers, they will be able to get the waiver for transaction fees, get the incentive reward, get the chance to speak up to set a policy or vote for the policy. So this is the whole thing will just compose the full fixed income market that we wanted to build. But look at us, where we are now. We are still not seeing any successful fixed income protocol in DeFi. So we're thinking about the automatic market maker, which I mentioned that it's not suitable for fixed income products. And we think of it that we seeing some protocol use peer-to-pool. Peer-to-pool is also not suitable for fixed income products. Because if you think of like similar to Aave, if we have a 4 billion of a deposit, but we only lend out the 1 billion, the 1 billion guys pays 4%, the 4 billion guys will get only 1%. So this is the capital inefficiency about the peer-to-pool. And then we may consider, should we go on layer 1 or 2 or 3? In layer 1, it's not suitable for order book because that might incur a high gas fee. Right? We needed to consider that. And then, what about layer 2 or layer 3? And what scalability we need? And we should optimistic or ZK roll up to build the peer-to-peer market. And we need to consider the auction privacy. We need to consider the compatibility with other protocol on layer 1. And how do we build that? So this is a solution we're going to provide. This is the key to unlock DeFi. So first of all, we needed to build up a ZK rollup. We call it ZK True Up. This is a customized ZK rollup, particularly for the DeFi and to do the ZK auction on fixed income products and the ZK order book for fixed income products. So with ZK True Up, we have a scalability. We can decide the gas fee. So we make sure that the user does not need to pay gas fee when they place an order or cancel order until they have a transaction done. So they pay transaction fees. And with ZK TrueUp, that we can make sure we have a privacy through auction. Of course, the most importantly, we need to make sure we have a data availability. We can control our roll-up frequency. Whenever we will have accumulated certain transaction volume, then we do roll-up. The auction process that we plan to do is 1 hour per auction. So 24 auctions per day, around the clock. So we wanted to use that and make sure that we have a data integrity, data availability. So the very important functions that I want to mention is that even with the data availability, even term structure, we shut down our website. The user can still claim their asset from Ethereum. So you don't need to worry about your fixed income tokens sitting with term structure. It is not. It's sitting on-chain. And we have forced withdrawal. So if you want to withdraw and we don't reply in certain period of time, then it will trigger evacuation mode. So then the whole platform will just get evacuated. So you don't need to worry about the safety of your assets on term structure. And then we do the composability. We use ERC20 and to make sure that we have a composability with other protocol. Particularly, we use the ZK TrueUp. So when we roll up, you directly roll up to layer 1. So you can easily to use this bond token with the value to interact with other protocol. In addition to the composability, I also want to mention that we will build the protocol level interoperability with other protocol. For example, the borrower's position, if you borrow 3 months, at the maturity date, if you don't want to repay for now, and you want to just keep it, and want to place an order at a better price to borrow, you can shift your borrowing position from term structure to, for example, Aave or Compound, and then leave an order here. Whenever you borrow your 3 months or 6 months money at the tokens at your preferred price, then you can shift your position, borrowing position from Aave back to term structure. Similarly, for lenders, if you have a bond tokens and you have a maturity date or you sell the bond tokens, you don't want to buy it today. You want to take a profit of your bond token and you want to sit and wait for a few weeks of time, and you can park your money, your tokens, at the Aave, and then you decided to move back to buy the bond tokens. 3 months later, you can do that. So this is what you can do. And of course, we use auction and the order book, right? So that is the key process that for you to decide the price you trade. It's not a take it or leave it. And here, on the reopen and the primary dealership, this is the system for you to make sure that you are comfortable with the liquidity. We use reopen. What reopen means in fixed income market, it means we will have the same maturity date for same token of bonds, so that every hour when we do auction, you can find the same bonds that the auction an hour ago or a day before, so that the same ERC20 token will continue to be minted on term structure. So you can use that to make sure that you have a higher volume of free float in markets. So we do that. And then, of course, that we use the primary dealership to enhance the liquidity. So we use the primary market, secondary market, Ripple market together to unlock DeFi. So this is the solution we're going to provide. And let's look at the evolution. Okay, we have just pick up 3 angles. The first angle is the cost. In addition to the on-chain lending protocol, paying the gas fee, which can be high or low, it depends on the timing of your transaction. And then the version 2 becomes the layer 2 fees. But we are building the customized ZK. As I mentioned, you don't need to pay gas fee if you place the order or cancel order. So you only pay when you have a transaction done, you pay transaction fees. The second angle is the efficiency. Right. I talked about the peer-to-peer versus peer-to-pool earlier. But the other efficiency is the automatic market maker versus the ZK order book. Like I said, the automatic market maker, you can only do the take it or leave it, and the market would not move if there's no transaction. Of course, on the order book, the market will move according to the market news or whatever incentive for you to transact at a higher or lower price. We don't need a real trade to be closed to move the market. So this is another evolution of a P2P and plus ZK order book. The third angle is the security with scalability. So initially, we have a centralized exchange that uses custodial wallet. So you have a scalability, but some people have concern on the security in terms of the credit risk. And then we move on to on-chain. Then we have a non-custodial wallet that you have a security, but you compromise your scalability. But here we have a V3 version, which you will maintain your non-custodial wallet, but we use ZK to make sure that you have a scalability you want. So with the three angle we provide, we will just give another evolution. Of course, that we believe there will be V4, V5, V6 that continue to move on. What about the use cases? Who are the users? This is the common questions that are being asked. So first of all, when we talk about the fixed income market, the group of people feel the most excited about is the option traders. They are looking for forward market. They are looking for fixed interest rate to pay. They want to pay fixed. They want to receive fixed. But they have no market. There's no way to do it. Now, I've seen option traders in one of the Hong Kong events on the stage talking about options hedging. How do they find the forward market to hedge? They find this, they trade options. They use the option pricing to re-engineer to get a forward price and to quote, trying to find the market to trade with them. This is just like if you are a real estate broker. You sell an apartment. You use the price of the apartments to be sold to find the price of the raw material, the bricks, the steels. This is what the re-engineers are doing, which is not efficient. We should go back from the beginning, the top, the bottom, right? We have a money market. Yes, we needed to build a fixed income and the interest rate swap step by step up to the forwards. And then, of course, investors and the margin investors, they need a fixed income market to provide the fundamental investment products, and then they can use repo to do leverage. And the miners, of course, that they have receivables they need to hedge. They can sell forwards. That's for them to hedge their future receivables. And then we have stablecoin issuers. The use case for stablecoin issuers is a very interesting one. If you think of the stablecoin issuers, all of their liabilities are current liabilities. You can think of an example who are having 100% of liabilities being current liabilities. That's a Silvergate. That's SVB. So they have a similar liability structure if you look at their balance sheet. Right. This is not their fault because in DeFi there is no such instrument for them to hedge. But here, with the fixed interest rate, fixed income market, primary markets, they can be the borrower to borrow the 3 months, 6 months against their 3 months, 6 months treasury bills. But of course, it comes with a cost. They need to pay interest rate. But that gives them the sustainability, right? I believe the community would like to see that. And then we have crypto service providers. They provide a structured product to retailers. And then they need to package structured products to get, by using the fundamental fixed income products plus the options or like a structured derivatives to add on top of that and to sell to their customers. And then account receivables. This is another interesting use case in the future. That you can think of that. If you want to pay $100 at the end of the year, but today you only need to use $95 to buy the bond token, which give you 100 at the end of the year. And you can use that to do the payment. This is very good for the supply chain payment, where you don't need to pay today, you pay 90 days later. And with this, you can use that to for the payment medium. Like I know some stablecoin issuers working with like credit card companies, trying to build up the payment in real time, right, for whatever you purchase. But of course, what about the payment in arrears? Payment in arrears means that you do the payment in the future, right? So you need to find something to carry the time value with a discount factor so that you can pay. And then real estate investors. Of course, those real estate investors, they need to hedge. So currently, we've seen some real estate products in market. What they do is they use USDC as an example, right? They assume USDC versus US dollar is one versus one forever. So that's why you don't seem to have risk. But what about if you want to use ETH to invest real estate? You can't, because there is no futures. There's no term futures. There's no forward market for you to hedge. You may earn 10% from the real estate, but in ETH, you may lose 50% 1 year later. So that's why this is very important. This is the foundational infrastructure for DeFi. This is another example from DeFi that we can learn. There's so many things that are similar from this DeFi world to DeFi. This is, on the top of the slide, is about the RMB internationalization. So CNY is the RMB traded or used in China. We call it onshore RMB. CNH is the RMB traded or used outside of China. We call it the offshore or CNH. So people, starting from 2004, the people are allowed to mint CNH by using CNY. Right? We're sending their CN1 to the clearing bank. Then you can take the CNH from like for example, Hong Kong, outside of China. So then they can also redeem CNH back to CNY. But here is 1 versus 1 always. Just like what we mint US dollar through the stablecoin issuers to stable coins. And then 1 versus 1, and you can redeem 1 versus 1. So gradually, the market use the CNH for payments. And that's for like a certain payments only, because there's no other place the CNH can be used. There's no investment tools. There's no demand for borrowing. There's no demand for lending. Similar to most people think today, or like 2 years ago. So in DeFi, we have an Aave compound developed, and that is also for us to use the crypto as a payment token, right? But up there in CNH, they use CNH as a payment currency. And then gradually, we developed the foreign exchange market. In this foreign exchange market, CNH and the CNY, they are not one-to-one anymore. So there is different friction, which makes the price difference. And then we have a curve. We have a Uniswap, which serves a similar purpose. And then about 10 years later, we've seen the fixed income market in CNH began to emerge. So there are 2 tiers of a fixed income market in CNH. One tier is the CNH invest in CNH bonds. The other tier is using CNH to invest CNY bonds. That is what we call real asset investment in DeFi. So, but in CNH, in RMB markets, we have built fixed income, we have built forward markets. So suddenly, 10 years later, the market becomes booming. And then we have a lot of structured products in CNH, or you can use CNH to invest in Y. So here, right now, we stop here. We need to continue to move on. There's a lot of things there's a lot of progress that we can learn from here, right? How do we move from the payment to investment currency? I think that's the thing we want to think of. And this is the last slide I have. So, a brighter future. This is something we want to build. Of course, that the community has to work with both regulators and the developers to build the full DeFi ecosystem with innovation, with blockchain infrastructure, DeFi infrastructure, or the market infrastructure. And at the end of the day, we need to have a DeFi to be as a service, as like, for example, as a payment medium for real time or for future payments. And then DeFi is a product that we see a lot of products that we can develop from here. And then eventually, we will reach out to the financial inclusion. There's no code, so like a bank the people and bank the people. So this is something that we want to build in the future. Thank you very much. And this is the feedback, that if you have any feedback, you can provide it to us. We're happy to listen what you think. And just to quickly announce that our testnet will be launched about 2 weeks later. We will make an announcement soon. Thank you.